Hello and welcome to Horizon Videozine. We are sharing today fundamental view of equity markets by JM Financial team, and we will be sharing our view of 2024. But at the start of the year 2023, we thought as an investor class that US will be slowing down and there could be a potential recession in 2023. But what it turned out was, very interestingly, even in the third quarter of 2023, US economy grew as fast as 4.9%, and that's something which was very, very strong. And US economy is likely to end with a full year growth rate of 2.6%. And that's the strong equity fundamental background for the world economy. At the same time, Chinese economy, which was supposed to be growing at a much faster rate, surprised us on the downside. Because of their real estate crisis, Chinese economy is growing at a much slower pace than what was expected for the year, and it didn't pick up the way it is. And China and US, being the twin growth economy for the world, offsetted each other in terms of world economic growth. Net, we had a good year of 2024, and as the inflation started to slowly cool off the way US Fed and politicians wanted it to be, we saw US Fed slowing down its rate of increases in the interest rates, and it took a halt sometime in third quarter of last year. What is our view in that context for 2024? Clearly, inflation is cooling off globally, and there is a lot of comfort on that front starting from this year onwards. What are we looking at in terms of rate cut in terms of, with respect to Fed? Very clearly, it looks like US Fed will start to cut rate based on the current trend of inflation sometime in June 2024. And that would be very, very positive for the global risk markets, mainly the equity markets, and especially for the emerging market. India, being a part of emerging market, should receive the flows for the positive side. What is happening on the fundamental front in the meantime on India? Clearly, we are looking at a very, very strong Indian economic growth rate. And if you look at a long term, on a 4 to 5 year basis, India is likely to emerge as one of the top 3 global economy after US and China. And that will be really, really big thing for global investors, and they cannot avoid India as an investment class. In terms of earnings growth, India has chugged along very, very fast, and it looks like after a growth of more than 20% in last 3 years, our sense is in next year, India in corporations will grow its earning at the rate of 15% and plus. And that's again a very, very good news for India. Indian banking and corporate balance sheets have come out post-corona as a very, very strong anchor for growth. Banks have provided for all the cleanup of the past, and Indian corporates have deleveraged themselves. And it looks like they are ready for the next growth cycle. And that's the biggest plus that we see for India economy. Driven by government's infra capex and overall thrust for the growth, we see clearly that will be the big support factor for Indian growth story for this year to come across defense, railway and power. Again, Indian corporates, which has deleveraged, our sense is selectively starting to look at the corporate capex in a bigger way, and based on the announcement and intention for their announcement on the corporate capex side, our sense is the Indian corporate capex cycle is also about to take off starting from this year. Given all this, and you add the Make in India movement that government is pushing with PLI scheme, production linked investment schemes that the government has rolled out across sectors, we see lots and lots of support coming in from that side also, be it listed or unlisted corporate doing capex, and that will add as a kicker to the Indian capex cycle. And you have a recipe for a reasonably decent growth for Indian economy. Indian economy is likely to continue to grow at a rate which is between 6.5% and 7% for a long time to come. And that is the biggest plus in the economy which globally is slowing down. And if you see, most of the large economies growing at a rate which is probably between 2 and below rates. And that's the growth differential that India offers to the investors, and we will be on the global investors radar for a long time to come. What's happening on the liquidity front, which supports the valuations of the equity markets? Clearly, domestic SIP has come off a long age, and every month we are looking at an inflow which is more like $1.5 billion, about 18,000 crores that is coming through SIP route in India. And that is giving a lot of buying power to our domestic mutual fund to support the domestic equity markets. What's happening on the FI front? After sell-off in last year, where the global equity market, the last to last year I'm referring to, there was a sell-off in the global equity market and FI had pulled out some money from India. From that level, and with SIP flow coming in India, FI's ownership in India's incorporation is coming down from a high of 20 plus to around 18%. And we believe this is a very good reason for FI to relook at their India portfolio, and maybe they should slowly increase their weightage of India given the India's growth rate differential vis-a-vis the world. If that were to happen, our sense is both the engine will fire. That is, be it domestic SIP flow or global FI flow. And if both of this is put together, you have a very, very decent chance that liquidity will continue to support the markets in the second half of this year. As a thumb rule, we are looking at $1.5 billion of investments through SIP, and on a good month, FIs invest around $2 billion in a good year on a monthly basis. And that's the equity power that we have as a liquidity. And now you add, for the supporting of dollar versus rupee, you add the bond index inclusion of India in the JP Morgan indices. And that is likely to start attracting bond flow in a bigger way from June 2024. And you have a recipe where Indian market is supported by liquidity quite a bit. Coming to the slowdown or a bear case where a lot of negative tailwinds which might affect the Indian markets, there are 2 or 3 factors which investors should keep in mind. One, global debt is ballooning, and hence 2024 will be a year where probably this debt will hit the ceiling, and maybe it could be a reason for a global growth to slow down. Rising US fiscal deficit is an area of concern, that continue to spend more than what they earn, and clearly that will be a pressure point for markets. And with interest rates at around 4% plus versus say 2 years back at 0, the repricing of that debt will continue to hit US fiscal deficit in a bigger way, and that will be a big point to watch out for the global investors. China real estate story could continue to wind down, and that could continue to affect the Chinese growth as well. Most of the investors are penciling in Chinese growth more in a band between 4 to 5%. And that's the thing where we need to worry if there are some collateral damages coming from that side. Overall, in that context, Indian valuation is a little bit stretched. If you look at index Nifty level of around 22,000 Nifty, clearly Nifty is trading at 21 times 1 year forward. And that's something which is one standard deviation above its long run average. If you look at last 5 years average, India is trading at 20 times on a 5 year average basis. And at 21 times, we are trading at about 5% growth premium that we are being paying for the markets. Again, if you look at emerging market averages on the MSCI side, our premium currently is about 26%, which used to be around between 10 to 12% since 2014. So there are pockets of concern in terms of valuation that investors need to vary about in terms of growth from the equity markets. What are the 2 key event risks that we are looking at in 2024? Clearly, it's going to be a Lok Sabha election of 2024 in May. Any surprises on that front will be a big factor to watch out for. Currently, market is poised for outcome, which is that BJP, with a decent showing in this recent December Lok Sabha, Rajya Sabha the state election, clearly the show was on the side of BJP, and the current investors' expectation is that the good show by BJP should continue. And in that context, our base case is that BJP will come back with a third term for the reforms to continue. If that were to happen, we are looking at a second half, as we said, a positive for liquidity, positive for fundamental, and maybe positive from the Indian political backdrop as well. Then comes the global geopolitical risk. This, we believe, will be the biggest event for the year to watch out for. Geopolitical risk is on the rise. Russia-Ukraine war is continuing in the background. And if that were not enough, we have started seeing, starting from this year, Israel and Gaza war starting to happen. And here comes a Houthi attack, which Red Sea is happening. We are seeing a lot of attack by Houthi, which is an Iran-backed group, which is attacking a lot of vessels in the South Sea side. And there is a risk that is emerging on that front as well, which we believe investors need to monitor very, very carefully for us to see how the equity markets will react to all these things. Put these things all together, we're quite positive about the Indian equity markets for the year ahead, but we need to keep all the risk factors that we have said in the background. So it's India story all the way, but global risks which we need to carefully monitor. And we believe the year should be really, really rewarding for the investors. What we would advise our investors is to buy every dip that can happen based on these global events with a view that we should build a good portfolio on a 1 to 3 year basis. Thanks.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.